Next part, we will go through the Pangli part A2. The requirement is we need to calculate the current ratios at the start and the end of January 2007. So what is current ratios? So here, just to recap your memory, the current ratio means current assets divided by current liabilities. So in other words, this is one of the key ratio that a lot of investors or the banks looking at, because they would like to know whether that the company liquidity, the liquidity is in good shape. So one of the key ratio that they are looking at is the current ratio, and we are required to work on the start and the end of January for the company Pangli. And here we can show you how to make it. So for current assets, it should be the inventory and or plus trade receivables and for current liabilities, is the trade payables plus overdraft. So at the beginning of January, we have, this is on the question, in the beginning of January, we have inventory, which is 455, and trade receivable, which is 408,350. And these are the current assets, and the current liabilities, including trade payables, which is 186,000, and the other is overdraft 240,000. So we got all the numbers for the start of January 2007, and we can make our calculation here. At the start of January, so we have $455,000 plus 408,550, okay, divided by 186,700 plus 240,000 and 250, and then we got the sum of the inventories and trade payables divided by the sum of current the liability, the trade payables and the overdraft. So the ratio is 2.02 times for the beginning for the start of January 2007. And how about at the end of the period? At the end of January 2007, we got the receivables based on our workings on part A1. We work with trade receivables by the end of the period, which is 470,000. And for inventories, we got 507,000. Payables 306 and 010. For the overdraft, end of the period of overdraft is 299,000. So we got all numbers, then we can work out for the current ratio at the end of January 2007. which is the inventories plus trade payables divided by, trade receivables divided by trade payables plus the overdraft. So here you got 977,250 divided by 605,100. Then you got 1.632 times. So we got all these answers for the current ratios asked by the question, which is at the beginning of the period, which is 202 times 2.02 times, and by the end of period is 1.62 times. All right. So this question is the most important part of this question is the definition of current ratios, and then you can work it out in the way that because we have already prepared works in part A1, so we just capture the numbers that we did. Then we can get the current ratios for the beginning and at the end of the period.